So last but not least, episode 6, exiting your business. Now there might be a number of reasons why you're exiting your business. You might simply be retiring and want to wind it down. You might unfortunately be in a situation where your business is no longer making money and you want to close it. It's really important when you close your business to make sure that you do it properly, to make sure that you deal with all the people that you need to deal with, such as third-party creditors, people like HMRC. It can be really useful to engage somebody called an insolvency practitioner to make sure that you follow the rules and don't incur any liabilities as a director for doing things the wrong way. On the other hand, you might be really lucky and exiting your business because somebody wants to buy it. If that does happen and someone's interested in making an offer for your business, they will at some point want to do something called due diligence. What that basically means is they're going to audit your business. They're going to come in and have a look at all of your documents, all of your paperwork, your client base, your products, your contracts. They'll ask you an awful lot of questions about finances, tax and other things. Therefore, if you are thinking of selling your business, it can be really useful to get someone like me in and your accountant to just go through everything and make sure that everything is in order. The last thing you want is them finding something that means they either decide not to buy your business at all or offer you something else lower for your business price. There are different ways of selling your business as well. It may be that you are going to sell the shares in your company. If that happens, then everything transfers to the new owner. That includes all your assets, but all your liabilities too. So as a buyer, they're going to want to make sure they understand what those liabilities are. The alternative is to just buy assets from your business. That being the case, they will literally cherry pick what they want. They may only want to take some stock or equipment or some customers. If that happens, then you will keep the company, in which case you will need to wind it down properly, as I mentioned earlier. Another important difference between selling shares and selling assets is the tax treatment. If you sell a company, you'll pay SDLT on the shares. If you sell assets, there may be CGT, capital gains tax liabilities. Accountants are the right people to ask about the impact of this on the price and the amount of money that will be left in your pocket at the end of the process. The other difference is the treatment of employees. If you sell shares in your company, those employees will transfer over with the company to the new owner. If you sell even some of your assets, it's possible that those employees will automatically transfer under something called TUPE. TUPE can be quite difficult and it kicks in sometimes when you don't expect it to. So again, if you're thinking of doing this process, it's one area where I do recommend that you get some expert advice from people like us and accountants that you're probably already working with. Hopefully by the end of this process, we'll be breaking open the champagne and all celebrating with you. So good luck, thanks for watching, and I look forward to talking to you again one day soon.